Yeah, super. Yeah, so my name is Fredrika, and together with Lamin, I will hold these tutor centers in finance. And today we will, I'll just turn my presentation. So today we will go through two questions from the practice exam that your teacher has given out from for 2020. And as I think you know, you will have the exam online, I think, but I hope that it will look the same as it has done previously. And this is the first of the 3 sessions that the tutor centers will be held at into Finance 2. So the next is the 4th of May, and then it's the 6th of May. And we will go through old exam questions and give some tips and informations along the way. So the first question I will start with today is the question 1 from the practice exam 2020. So if you want to take it up and have it in front of you, I think that would be quite good, since it's quite much information that it will be handled during this question. So we will start going through which information that is given. So we know that we have the telecom firm Crapo, a telecommunication firm that is considering a new capital budgeting project in the pig farming industry that would generate sales for 3 years. And I forgot to say, if you have any questions, just scream, and because I can see if you raise your hands. So they are thinking about a new capital budgeting project, and they know that the expense for research and development at t equaling 0 will be $40,000. They know that revenues at year 1 will be 400,000, year 2 will be 100,000, and year 3 500,000. The cost of goods sold are expected to be 30%. And general selling and administrative expenses is expected to be 10% of the revenue. We know that the purchase of the machine is 90,000, and that is laid out at year 0, and it's depreciated over 3 years. We know that the tax rate is 35%, and we know that in order to conduct this project, they need an inventory that is new, that is like additional to what they already have. So we know that the additional inventory will be 5,000 at year 1, 10,000 at year 2, and 8,000 at year 3 and then going back to 0 at year 4 when the project is over. And we also know that we have a comparable firm which has the debt to equity ratio of 1, the debt beta of 0.4, and the equity beta at 1.2. And we know that our firm has a debt to equity ratio of 1.5, a debt beta of 0.4, and a market risk premium of 5%, and a risk-free rate of 3%. So this is all the information that is given in the question before even stating any sub-question. So the first sub-question that we are going to answer is that we should calculate the free cash flow for this project that is given to us. So always when we are trying to calculate a cash flow and we have all these transactions or like stated costs and cash flows and revenues, we need to divide every piece of information that is given to us into 2 categories. The cash flows that would go through the income statement and will thereby be affected by the tax, and the ones that won't go through the income statement and thereby won't be affected by any tax. And the reason that we need to divide this is that the tax aspect will affect the size of the cash flow that will be generated each year. So we will go through step by step all the costs, revenues, and cash flow stated, and consider which ones are needed to taken into the income statement. So the first cash flow mentioned is the sales, and as the sales are a revenue, So all the revenues and costs goes into the income statement. And as sales are a revenue, it needs to flow through the income statement. So that you can just check or make a mark or something, so you remember that this will go through the income statement. Then we have the cost of goods sold. And since this is a cost that is linked or connected to the sales, this also needs to go through the income statement. And the same go for the admin and selling and the general expense. The R&D, this is a more tricky post because it doesn't always go through the income statement. As you might remember, R&D was a cash flow that was happening at year 0 before the project even has been conducted. And if R&D is a part, it depends if it's a part of the income statement. And it depends on if you can use tax savings associated with the expense in order to account for it. So in this question, it is clearly stated that research and development could be expensed as a part of the income statement, since it could be deducted from the other revenues that the company has that isn't associated to this specific project. And then we have the depreciation. The depreciation will always go through the income statement. It is a cost associated, it's a cost created to distribute the cost throughout the years for since they bought the machine. So it's stated that they bought the machine for 90,000, so the depreciation will be 30,000 each year, and it will go through the income statement. And then we have the capital expenditure. I will just see what was the capital expenditure. Yeah, it doesn't go through the income statement because it doesn't affect the profit of the company. And then we have the changes in the VSE, and that won't go through the income statement since it is not a revenue nor a cost. Everything clear so far? No question? Perfect. So now we know that we need to draw up an income statement that we later will tax in order to receive our cash flow, free cash flow. And we know that the sales, the cost of goods sold, the admin expense, the R&D, and the depreciation will go through this income statement. So if we draw that up, it's a bit blurry, but I think you will see. As I said in the beginning, we know that the sales year 1, 2, and 3 are 400,000, 100,000, and 500,000 respectively. We know that the cost of goods sold are 30% of the sales, so that we just calculate and put under. We know that selling, general, and administrative expenses are then 10% out of the sales. We know that the R&D investment was at year 0, 40,000, and that it could be deducted against other revenues that the company had, so it is part of the income statement. We know that the depreciation was distributed equally throughout the years, and that the initial cost was 90,000. And by that we get the EBIT, which is the earnings before interest and taxes. And in this question, we don't have any interest costs or interest income. So we just now can tax the EBIT, which we know what was a 35% tax rate. And then we get the unlevered net income, which is the the cash flow from the, it's like the profit. So it is seen as a cash flow for the things that go through the income statement. But as I stated before, this is not all our cash flows. we now have the categories of the items that doesn't flow through our income statement as well. And those like posts were the capital expenditures and changes in the working capital, as well as the initial cost for buying the machine. So even though the depreciation is spread throughout the years here, the depreciation isn't a cash flow, right? It's just a created cost to distribute it more equally throughout the years. So in order to reach the true free cash flow, we begin from the unlevered net income, which is calculated before. And now we need to adjust for the posts that are part of the cash flow, free cash flow, but hasn't flowed through the income statement. So we begin by adding the depreciation again, since the depreciation isn't a cash flow. We know that the working capital isn't a part of the is a part of the free cash flow, but hasn't been a part of the income statement. So we need to add for the changes throughout the years for that one. And we know that the machine the cash flow for the buy of the machine hasn't been accounted in the income statement. So that we need to adjust for as well. And when we adjust for that, we receive the total free cash flow for this project for each year. So here we have year 0 and year 4 when the project is finished. Any questions so far? Super, then we continue. The second question is that we should calculate the net present value of this project using the weighted average capital, eller WACC method. And always when we should calculate the net present value, we need two things. We need the free cash flows, and we need the rate that we are going to discount it with. And from this question, since we already done the first question, we already have the free cash flow as we calculated before. So now we only need to find the WACC. And as you know, the equation for the WACC is as stated here at the B section. So it's part of the equity through the value of the company, which is the equity plus debt, multiplied with the equity cost of equity, and added with the debt through the value of the company times the debt rate and times the one deducted with the tax. So in this question, always when you receive questions that when you should calculate the WACC in this course, it is quite difficult, or it requires a lot of equations in order to receive all the variables that you need to solve for the WACC. So what I always do in order to don't miss a step or to get lost on the way is that I always begin to state the WACC equation and then begins to write the equation for each variable so I don't miss any. By doing that, it becomes fairly easy to see what you need which equations you need in order to calculate for the WACC. So for the first variable, we need to have the equity divided by the value of the company. We also need the debt through the company value, which is the equity plus debt. So this is the first equation stated. We also know that we need the rate for the debt, and that is the risk-free rate added with the debt beta times the market risk premium. We know that we need a cost of capital, which can be written in two ways actually. Which the first one is exactly as the debt rate, except that you change the beta to debt beta to the equity beta. But the second way to write it is the unlevered rate of return added with the debt to equity times, the unlevered rate minus the debt rate. And in order to receive equity rate, we need to know that we need the unlevered rate as well. So then we write the equation for that, and that is the risk-free rate added with the unlevered beta times the market risk premium. And from that equation, the only thing we don't have is the unlevered beta. And how do we receive that? As I stated before, we received some information about a similar firm that conducted the same type of project, and we received their debt to equity ratio, and we received their equity beta, and we received their debt beta. And since the assumption is that the unlevered beta should be the same for these two similar projects, so that is what we will use in order to receive the unlevered beta. And we know that the equation for the unlevered beta is the equity divided by the company value times the cost of equity added with the debt through the company value times the debt rate. And we know that the debt to equity ratio for the comparable firm is 1. And by that we can, and when I receive a debt to equity ratio, I assume that the debt, if the debt to equity ratio is 1, then you can put the debt as 1, the debt as the number that is stated to be the debt to equity ratio, and the equity to be 1. And by putting that into the equation for equity through the company value, you can receive that component. So for the comparable firm, we know that the unlevered beta is the following. And by that, we get the unlevered beta as 0.8. And as what I have done here is to set the equations in the exact opposite order as the slide before, because before we worked from the WACC down to each variable that we needed, and now we start in the other direction in order to receive the WACC. So the next equation we need to do is the unlevered rate of return. And with the equation stated before and with the numbers given, we know that is 7%. And then when we calculated the unlevered rate of return, we can calculate the equity rate of cost of capital, or equity rate of equity, and that becomes 10% with the numbers given. And then we can calculate the debt rate, which becomes 5%. And then we calculate the debt through the company value and equity through the company value, and we receive 60, respectively 40%. And now we have all the components we need to solve for the WACC that we need to have in order to calculate the NPV. Any questions? Super. So now when we have received the WACC and we have the free cash flows from the last questions, all we need to do is discount the free cash flows with the WACC that we have calculated. So that we do here on that slide. And now it's important to just keep your mind straight and like discount it with the right amount of years, so that you don't forget that the first year at year 0, then you don't need to divide by anything. And then we know that the net present value of this project is 256,889.12. Super. The third question is that we should calculate the project's debt capacity over the project. So first, what is the debt capacity? The debt capacity is how much debt the company is having throughout the time of the project. The size of the debt capacity differs throughout time since it depends on the value of the company. Furthermore, since we have assumed a constant debt-to-equity ratio throughout the project, as you always have to do when you're calculating the WACC of a company, of a project, I mean, the size of, since we assume that it is the debt-to-equity ratio is constant, the size of the debt need to change when the value of the firm is changing throughout the years. And as we calculated before, we know that the debt through the company value, like the percentage of the debt should be for this project, is 60%. So what we need to do in order to receive the debt capacity is to take the company value at each year and multiply with the debt capacity. Yeah, so here you see the debt capacity is the levered value of the firm times the amount of debt that the company has in this project. And we know that it's 60%, and we know that the levered value of the firm is the future cash flow discounted to today's value. So in order to receive the levered value at year 0, we discount the cash flows received at year 1 to 4 to today with a WACC rate. And we know that the levered value at year 1 is received by discounting the cash flows from year 2 to year 4, and so on and so on. So that's what we will do. We take the levered value at year 1 by taking the free cash flow at year 1 divided through the WACC, and cash flow year 2 divided with the WACC, etc. And then we receive these numbers. And I will give you some time to write this. Everybody done? Yeah, I assumed. Okay, so now we know the levered value of the project at each year. And what we need to do then is to calculate the debt capacity is to take the levered value times the debt capacity, in percentage. So here is the value, levered value of the firm stated in the in this section in the middle. And then to reach the debt capacity, you multiply the levered value times 60% to reach the debt capacity, which is stated at the lowest row. Important to know is that when a project is finished, like when it's over and you know which year it is over, the value of the firm should always be 0 at that point of time, and then the debt capacity is always 0 as well. So that can be a great tip in order to check that you have done this correctly when you're calculating questions at exam or prior to that. Now we will move on. The fourth question is that we should calculate the net present value of the project using the flow to equity method. So what we're supposed to do now is like the same as we've done in the previous question, but we should now use a different method. So what is this method? Firstly, we need to know that this is a net present value. So in order to calculate it, we need some kind of free cash flows, and those need to be discounted by some type of rate. And the rate used in the flow to equity method is the return on equity, as a RE. In this component, we have actually already calculated in the first part of the question. So we know that the RE is 10%. So that is already done. Furthermore, we need to find the correct cash flow. The specific cash flow that we are searching for now is all the cash flow flowing to the equity holders. So that is the definition of this method. So therefore, all the free cash flow to the equity holders are calculated as in A. So one could say that the cash flow to equity holders is like the free cash flow, but and then deducted from with the cash flow that goes to the debt holders. I would say that is the easiest way to calculate it. So from the first questions, we know that the free cash flows, what the free cash flows are. And now we just need to know what the cash flows to the debt holders is in order to deduct it from the free cash flow and receive the cash flow to the equity holders. And what flows to the debt holders then? So every time we deduct or we pay off on our debt or take on a new debt, it is cash flows floating from or to the debt holders. So that we need to adjust for when calculating the flow to equity. We also know that interest rates paid are a part of the cash flow that is floating to the debt holders. So that we also need to calculate. And we know that we have some type of tax shields coming from the interest rates that we pay. And that we also need to take into account when calculating the cash flow to the equity holders. So we begin by calculating the net borrowing. So the net borrowing is the borrowing, the difference in the debt capacity between 2 years. So we know that at year 0, when the project begins, the debt capacity is 2,000, like what is stated here. And we know that the year before that, it was 0. So at year 0, we have taken in debt of this size, which means that the net borrowing is the same as the debt capacity at year 0. At year 1, we can see that the debt capacity has decreased, which means that we have paid off, we have returned some of the money to the debt holders between year 0 and year 1. This means that we have a negative cash flow since it's cash flow floating out of the project instead of in. To year 2, we can also see that the debt capacity has decreased, which means a negative cash flow again, and then it continues to decrease until it is 0. So therefore, now we have calculated the net borrowing, which is the following, which is the first part of what we are going to have to deduct from the free cash flows. And the second part we need to deduct is the interest rates. And we know that the interest rates are the last year's debt times the cost for debt. And as we calculated in the first question, the cost of debt is 5%. Furthermore, one can take into account the tax shield already here. And the tax shield is something that is a part of the deduction of the free cash flow to the flow to equity, since it increased the equity holders' cash flow. This is due to the fact that the interest rates are a part of the income statement, and by that it decreased the revenue and decrease the tax that is paid. So in order to account for the tax shields, we can take it times last year's borrowing times the interest rate times 1 subtracted with the tax rate. So that we do for each year as well. And this as well is a cash flow to the debt holders. So now we know all the 3 components that we knew was classified as cash flows to the debt holder, which was net borrowing, interest rates, and tax shield. And by deducting these from the free cash flow that we calculated in the first question, we can receive the free cash flow to equity holders by taking the net of it. Any questions so far? Something that is unclear? Super, I will give you some time to write these off. Super. And an important thing is that in all these questions, even though it is stated that the project only continues throughout year 1 to the end of year 3, you have to include year 0 and year 4 as well, since some of the cash flows occur in these time periods as well, so that you don't forget them. So again, to repeat, in order to receive the cash flow to the equity holders, all we did was taking the free cash flow that we already have calculated and deducting the free cash flows that we know are going to the debt holders. Because the free cash flows is only distributed between the equity holders and the debt holders in this case. So now we will go to the last questions for this first question. No, sorry. Now we have received the free cash flow to the equity, but the question was to calculate the net present value through the cash flow to the equity method. So what we need to do now, as always, is to discount the free cash flows. And as we stated before, we should discount it with the RE rate, which is 10%. And when discounting it, you receive the net present value of this value here. Super. So the last question that we are asked to do is to calculate the present value of the interest tax shield for this project using two approaches. So first we need to know what an interest tax shield is. So as I said before, as I stated partly before, the basic assumptions that we learned in Finance 1, in the course Finance 1, is that the financing structures, like if you finance your project with debt or equity, doesn't matter for the value of the firm or the project. However, in the reality, it actually matters, since by financing through debt, the company values becomes higher since the interest rates are tax deductible. So the cost for the debt is is a part of the income statement, which means that the tax becomes less due to the cost. So due to this, debt is somehow preferable over equity since the value of the company becomes higher. So that is what the interest tax shield is. It's like the difference between the value of the company when it's unlevered with no debt and the value of the company when it has debt in it. And the value when the firm is financed through debt is always somewhat higher. So the two methods that we are going to use are the indirect method and the direct method. The indirect method is that we take the levered value of the firm, which is the value of the firm when we use debt to finance it, and we subtract the unlevered value of the firm, which is the value of the firm when we assume that we only finance it through equity. And the unlevered value of the firm we have already calculated in the second question, which was when you discount the free cash flow of the levered firm to the date or the year that you are looking for. And when we are looking for the unlevered value, we are doing the exact same thing, and we're discounting the cash flow, but now we are discounting it with the unlevered rate of return, which is RU. And RU is the rate that we have already calculated as well in the previous question, and that was equal to 7%. So what we do in order to receive the unlevered value of the firm is to take the first free cash flow that we calculated in question A for each year and then discount it with the rate of return, unlevered rate. And then we receive the unlevered value of the firm, which is this. The levered value of the firm, which we calculated when we were supposed to calculate the debt capacity of the firm at year 0, is the following here. And this number is just collected from the third question. And then, as we can see here, the value of the firm, or the project in this case, is higher when we are using debt to finance, when the firm is levered. And this is due to the tax shield. So in order to receive the value of the tax shield, we now take the levered value of the firm subtracted with the unlevered value of the firm. And then we reach 7,601.54 as our tax shield. However, as stated before, we should calculate the tax shield through two methods. And this was the indirect method. The direct method is to calculate the interest tax shield by calculating the interest expense and then discounting with discount it with the unlevered rate of return as well. So now we will do that. So in order to discount or to reach the interest tax shield through this method, we need to calculate. We need to calculate the interest expense each year, and the interest expense will be then multiplied by the tax rate, since the interest costs, which is the debt capacity times the rate of debt rate, it will be, since it will be a part, as I stated before, of the income statement and thereby will reduce the tax, you will have to take the interest costs multiplied with the tax in order to receive the tax shield each year. So the tax shield is each year is what you save by financing through debt instead of equity. Because if you didn't finance through debt here, you would pay 3,000 at year one. You would pay 3,915.34 in tax either way. So thereby you save money. So when you have calculated the interest cost times the tax rate for each year, we need to discount it in order to gain the total interest tax shield, which we are after. And again, when we calculate the tax shield, we discount it always with the unlevered rate of return. As you can see here, when I've taken the cash flows divided with the rate each year. And I want to state that even though it isn't asked that you do both of these methods when you're calculating a question on the exam, I highly recommend that you do it both ways, since in these questions, like total questions, each sub-questions build on another sub-question, which means that if you calculate something wrong in the first question, there is a risk of always of every sub-questions following becoming slightly wrong. So if you're calculating only through one method, or if you're calculating with the both methods in order to receive the interest tax shield, you can easily see if you have calculated the interest tax shield right, but always if something else in the other sub-questions are wrong. Because if you don't get the interest tax shield the same through both these methods, something else in the previous questions will be wrong. So that was the question 1 from the practice exam from 2020. Do anyone have any questions about anything from this question at all? Okay, super. Then I think we will take a 5-minute break, and then Lamin will go through the question 3 from the practice exam 2020.
Hello everyone and welcome back. Can everyone hear me? Okay, fantastic. So I am Lamin and I'll take you through the third question from the practice exam that Fredrika talked about. So in this case, in this slide, we have a summary of the information that we were given in the exam paper. But before we start, feel free to raise your hand if you have any questions or any clarification you would want to make. So here we have a project that's going to be for 1 year, and we have some information about this project. We know that the number of shares of the company is 100 million. We also know that the company is all equity finance. So that means that the company do not have any debt. We know the equity beta is 1.2. And we know that we are asked to make an assumption that we have perfect capital markets in this case, right? And we have two additional information, which is the risk-free rate and the market risk premium. In addition to this, we have the cash flows of the project. And so we have 4 possible states of the world. One way to think about this is that from 1 year from now, we are not so exactly what's going to happen, but we are so that there are just 4 scenarios that could happen. And in each of the scenarios, we have the cash flows we expect to get and the probability of realizing that particular scenario or state of the world, as it is called usually. So before we move on to solve the questions, I thought it's important to recap the key assumption of this question, which is implications of perfect capital market. So what this means, one is that the markets are competitive, and this means that both investors and companies have the same opportunity. And the importance of this is that if this is the case, it means that investors will not have a preference for any particular company based on their capital structure. Because what happens is that investors can always replicate the capital structure that they want to achieve in the market by their own. So they don't need companies to do this for them. And because of this, capital structure wouldn't be an important preference for investors with regards to companies. Another assumption of perfect capital market is that there is no information asymmetry, which means that everyone knows the same amount of information. So the managers of the company do not know more about the company compared to the investors of the company. And why this is important regarding perfect capital market is because if this is true, it means that issuing debt or equity do not have any additional information power. For example, if there is no information asymmetry, when companies issue equity, investors outside of the company assume that maybe the company is overpriced, or at least it's priced correctly and not underpriced. Why this is the case? This is the case because if the company was underpriced, it is very unlikely that the owners of the company or the managers would issue equity, because it means that they would be selling something that is already cheap in the market. So this is why it's important that for the no information asymmetry assumptions to hold in the perfect capital market. The third point is no transaction costs and no taxes. Here I would emphasize on taxes because in the first question, Fredrika talked about interest tax shield, and interest tax shield has an implication on company value. So if there are no taxes, it means there are no interest tax shield, and then capital structure would not affect company valuation. The fourth point is that operating decisions are independent of financing decisions. What this means is that companies do not have to give up good investment opportunities because they have financing constraints. So if these 4 assumptions hold, it means that we have a perfect capital market. And if that is true, then the company's cash flows, CF means cash flows, are not affected by capital structure decisions. So this is quite an important point to remember when solving this question, because this is an assumption that you would have to make in order to solve some of the questions asked here. With that said, now we move to the fourth question. Here we are asked to solve for the cost of equity and the expected cash flow per year. To do this, we need to come up with information on certain variables. For example, we need to know what is the expected cash flow of the company in year t equals to 1. To do this, we have 4 cash flows, if you remember from the first slide here, and we have the probabilities that we realize each of these states. And so the expected cash flow is basically the weighted average using the probabilities for each state and of the cash flows that we expect in each individual state. So if you take the numbers from the table and plug it into this formula, you arrive at an expected cash flow of 220 million. It is important to remember that this cash flow is at time t plus 1. So if you want to know the value of this cash flow today, which is 1 year less, you would need to discount this. And because of this, we need to find the cost of equity of this company or this project. One important information that we had from the previous slide was that the company is all equity finance. And because of this, it means that the cost of equity is the same as the unlevered cost of capital because there is no debt in the company. At the same time, we have the risk-free rate. We also have the market risk premium, and we have the beta of equity. And with this information, we can find the cost of equity using the CAPM, which is a very famous concept in finance, and I'm sure you are quite familiar with. So now we have the formula for the CAPM formula for the cost of equity, which is basically the risk-free rate plus the beta of equity times market risk premium. And this gives us a cost of equity capital of 12.2%. So now we have the expected cash flow in year T plus 1. We have the cost of equity, and then it's easier now to calculate the expected cash flow per year, which in this case is expected cash flow in year 1, right? So the investors in this project would expect a total cash flow in year 1, which is equal to 220. And the number of shares, we know that the number of shares that the company has is 100. So the cash flow, expected cash flow per equity in this case would be 220 divided by 100, and that gives you $2.2 per share. Then the third part of this question is the share price. To compute the share price, we need to know the present value of the expected cash flows, and we need to divide it by the total number of shares that the company has. So already we have found in the previous point the expected cash flow at time t equals to 1. All we need to do, we need to divide this amount with, we need to divide that amount with the cost of equity, and that's what we did here with this line here. And when we do that, we have 196 million as the present value of the total cash flow that the project expects. And things that we already know the total number of shares, once we divide this total cash flow with the total number of shares, we arrive at the price per share, which is 1.96. And that solves this first part of this question. Does anyone have a question regarding this? Good. So we will proceed to the next part of this question, which is debt financing. So what happens here is that the question introduces sort of a new concept, which is that the project would take on some loan. We know that the face value or the future value of this project, of this loan, debt is 20 million. And what we are asked to do is to find the present value of the debt. To find the present value of debt or any cash flow for that matter, all you need is the cash flow and then the discount rate for the cash flow. So cost of debt would be the discount rate for the debt cash flow. And like any other cash flow, the cost of debt should reflect the riskiness of the debt in this case, right? And there are generally two ways to estimate the cost of debt. You have the CAPM formula, which is more or less like when we calculated the cost of equity, just that you need to substitute the beta equity with the debt beta. But it's important to know that generally in questions, you probably would be given beta for debt if you are asked to do this. But in practice, maybe if some of you like to implement some of what you've learned from school, by buying stocks or trying to analyze stocks. In practice, it's not very obvious to drive the beta of debt. And because of this, usually people use a rule of thumb, which is by which they use 0.1 if the debt is investment grade, or 0.3 or above 0.3 if it is non-investment grade. And this classification depends on the credit rating of the debt. But then this information is just for practical purposes. Generally, in exams, you would always be given the beta of debt, and you would use the beta of debt in the CAPM formula to calculate the cost of debt. The other method of estimating the cost of debt is using the market yield on debt with similar risk profile. What is important in this case is that the yield should reflect the risk profile of the debt that you are analyzing. And usually to understand the risk profile of a debt, we use the credit rating, which are issued by rating agencies like S&P or Moody's. So if you come back to the question here, we know in this specific case, we know that the debt is riskless. There are no risks associated with this debt. And how do we know this? We know this because first, we know there are 4 possible states of the world, and we know the cash flows in each given state. And at the same time, we also know that the cash flows in each given state is higher than the future value of the debt. So what this tells you is that no matter what happens, the company or the project will be able to get enough cash flow to pay the debt holders. And if this is true, it means the beta of debt is 0. And because of that, then the cost of debt is the same as the risk-free rate, which in this case is 5%. Right? So I think one of the most important things to remember here is to try to understand what is the risk of this debt. And since in this case, we already know all the cash flows that we expect in every given state, it's just understanding whether there are any given states when the cash flows would be lower than the debt value. If this is not the case, then the debt is considered as riskless. So now we have the cost of debt, we have the future value of debt. To calculate the present value of debt, we basically discount the face value of debt with the cost of debt. In this case, that would give us a present value of 19.05. And that answers this, the second part of this question. Does anyone have a follow-up question on this? Good. So we proceed to the next one, which is quite fairly simple relative to the other one, which is the share buyback. So what this question is telling us is that the project wants to use the cash flow from the debt to buy back some of the company's shares, right? And from the previous question, we know that the amount of cash that the project is receiving from the debt is 19.05, right? And at the same time, we also know from the previous question that the share price is 1.96. And so we can fairly easily find out how many shares can the project be able to buy with this amount of cash flow, which is basically the 19.05 divided by the price per share. And this tells us that the company would be able to buy back 9.71 million shares. And once you solve this, something that is important to remember is now that you need to always consider, going forward, you need to consider the new shares outstanding, which is different from the 100 million before. Because as we already discussed here, you've already bought back some shares. So this would decrease the number of shares that you have in the project now. The fourth part of this question is, what is the capital structure once you buy back the shares? Before, we were told that the company was fully equity financed. And in the second part, we know that it takes some debt. And now what we need to understand is what is the composition of the debt and equity of the company at this point in time. So here, our assumption of perfect capital markets becomes quite important, because that's one way which would help us to understand what is the value. what is the capital structure now? Because we know that with the assumption of perfect capital market, whatever the company does with its capital structure, the value of the cash flows remain unchanged, right? Because there is no interest tax field at this. So what this tells us is that the value of the company is unchanged. It's as the amount that we found in the previous question, and it's 196 million, right? Nothing has changed with respect to that. What has changed though is the composition of this amount, right? So it's how the company has decided to, or the project has decided to slice the cake, right? Before it was all equity, now it's debt plus equity, right? So we know that the face value, the present value of the debt is 19.05, and we know that debt plus equity is always equals to value. Then we just need, in this case, we just need to solve this equation, right? We know that then we know that the new equity is equal to the value unlevered, the value as if there is no debt, minus the debt amount, right? And this gives us a new equity value of 177.03 million. Once we know the new equity value, the present value of the debt, to find the capital structure, we basically divide the two numbers. We divide the amount of debt with the amount of new equity, and this gives us a capital structure of 10.76. Okay, there is a question here. Can you explain why you did that on D? Can you unmute yourself? Can you unmute yourself and put your question so that everyone would hear you? Is that okay with you? Emma? So Clara, is it possible that you can unmute yourself and ask the question that you have? Oh, you prefer not to speak. Okay, that's perfect. So let's see, let me read and understand what the question is about. So let me write it like that. So why we calculate the debt like this is that the present value of the debt, for example. So we know that in the future we need to pay 20 million to the debt holders. So that's the future value of the debt, right? Or the face value of the debt. So if you know the face value of the debt, to find the present value of the debt, you just need to calculate the discount rate for the debt, which is the cost of the debt, right? But in this specific case, we know that the debt is risk-free. We know that the debt is risk-free, so we just discount the future value of the debt with the face value and and get this amount, right? And in this particular question, we know that in perfect capital markets, there is no interest tax field. So even if the company has taken a new amount of debt, it doesn't affect the value because they don't have any tax benefits from taking up of the new amount of debt, right? So since we already knew the value of the company before, and we know that this value has not changed, and at the same time, we also know that this value equals to the value of the debt plus the value of the equity, it's fairly straightforward that when we take the value of the debt from the total value, we arrive at the new value of equity. I'm not sure if that answers your question, Clara. Okay, fine, thank you. Right, so now back to the question. Now we know that the new capital structure is 10.76, right? And yeah, so we move to the fifth part of this particular question, and that's what that asks us is that what is the return on equity, and then the expected earning per share of the project. Again, here also we need to fall back on the Modigliani-Miller theorem that we know that the return on asset, or sometimes called the unlevered return, is unchanged, and we know that it was 12.2%. So if it's unchanged, it means that it's still 12.2%. So we need to find the new return on equity, right? And here we can use this formula, which is slightly different, which is different from the CAPM. but it's also another way of finding the cost of equity, but also the cost of equity. So we know that the unlevered cost is 12.2%, and we know that the cost of debt is 5%, and we know the capital structure of the company now is 10.76%. If we plug in the numbers into this formula, we find a new value for the return on equity, which is 12.97%, right? And here, something worth of noting is this term here, which is the unlevered return minus the risk cost of debt times the capital structure, right? This is generally in finance referred to as the leverage effect, right? Which is the effect of the debt. And what D over E, which is the capital structure, does is that it amplifies the returns both in good times, which means when the unlevered return is higher than the cost of debt. In this case, this term here is positive, and then the overall return on equity increases. But also in bad times, when the unlevered return is lower than the cost of debt, in which case that this term here is negative and the return on equity is decreased, right? So this is basically how debt changes the riskiness of equity value in the company. The other part of this particular question was the expected EPS, right? Now, what we need to keep in mind is that before, when we calculated the EPS, we had just one stakeholder in the company, which is the equity holders, right? And therefore, all the cash flows belong to the equity holders. But now, what happened is that we have two stakeholders. We have equity holders, but we also have debt holders, right? And in any case, because debt holders have a contractual claim, they are always the first to be paid before the equity holders, right? So in this case, what we need to keep in mind is that to arrive at the equity to the cash flow to equity holders, we need to remove the amount of debt from the total cash flow in order to find the cash flow to equity holders, right? And divide that number with the total number of shares that are in the company, right? And here again, we need to keep in mind that the total number of shares have changed compared to before because we have bought some of the shares back using the debt, right? So we know that the total cash flow that we expected in year T equals to 1 is 220. We know that we need to pay debt holders 20 million. So that gives us 200 million as cash flow to equity holders. And if we divide that by the total number of outstanding shares, we have a new EPS of 2.22, right? Yeah, so here below here, I just emphasize what I said before. Now that we need to keep in mind that there are two claimants for the company's cash flows. One are the debt holders, which needs to be paid for, and then there are the equity holders, right? Yeah, any question? Okay, good, we'll proceed. So now we have the second to last part of this question. And here we are asked about the new share price, right? After the changes to the project capital structure. So in the first point, to obtain the new share price, we need to use the new expected earning per share that we already calculated in the previous one. And then we need to divide it by the new return cost of equity, right? Which we already calculated in a previous question. So that gives us the expected EPS. Now we know it's 2.22. We know that the new return on equity is 12.97%. If we divide this, the 2.22 with the new cost of equity capital, it gives us a price per share of 1.96, right? Which is exactly the same price per share that we had from the previous questions, right? And what this tells us is that when there are perfect capital markets, that value does not affect the total value of the company. So despite the fact that this company has already took 20 million in new debt. The value of the shares remain the same. Nothing has changed in terms of the value of the equity value of the company, right? Because there are no interest tax here. Okay. Then we move to the last part, I think, of this particular question, and this part is more of a qualitative question. I think it reflects sort of understanding about the perfect capital market assumption, but also the Modigliani-Minard theorem, right? So what it asks us is the effect of leverage recapitalization when markets are perfect. The first point is the share price, which remains unchanged. So the price per share has not changed. As we see before, it's still 1.96. And so we can decompose this because we know that the price per share is made of the expected earning per share and the return on equity, so the cost of equity, right? In this particular case, we know that the expected EPS increased with the leverage, right? But we know that also at the same time, the required return on equity has also increased because the risk for the equity holders have increased with the new amount of debt. Or another way of thinking about this, another way of thinking why the share price remain unchanged is that because we are assuming perfect capital market, it means that the capital structure decisions do not affect the cash flows. And if the cash flows of the project do not change, the free cash flows of the project do not change, it means that the value of the company cannot change. So it means the equity value would have to remain the same, right? The only thing that is compensated with the higher cash flow is the extra risk that the equity holders are taking. The second part is the expected return on equity, right? How does it affect, how does the leverage recapitalization affect the expected return on equity? And here we know that the cost of equity goes up because we've already calculated it. And we know that it moved to 12.97 from 12.2, right? So it went up. That we already know. But I guess here what's important is why does it went up, right? And it went up because now it means that the equity cash flow, the free cash flow to equity holders, co-varies more with the market than before, right? Because now whatever cash flow that the project gets, it has to deduct the cash flow to debt holders before before you get the cash flow to equity holders, right? And because debt holders are always first in the line, it means they would have to be paid first before the equity holders have to be paid, right? So another way of thinking about this is that the beta of equity goes up with the new amount of debt, right? Yeah, and yeah, so that's it. So taking on debt increases the riskiness of equity as equity holders have a residual claim. So they are always the last to be paid, right? So if there is a bad time when the cash flows of the project do not exceed the cash flow to the debt holders, it means that the equity holders will not get anything back. And this is sort of an extra risk for the equity holders. Yeah. And then the other part is the expected earnings per share of the company. And from here also we've done the quantitative part of it. So we have calculated the expected earnings per share, and we know that it increases to 2. If you refer back, we know it increases to 2.2, and it was before it was less than that. Let's find out what was the value before. Before it was 2.2, and we know that now it's 2.22. So it has gone up, right? And the logic here is I think the point here is to explain why it went up, right? So we know that it went up because the expected cash flow to equity holders, even though the expected cash flow to equity holders decreased, at the same time, the number of shares in the company also went down because we know that the company used the debt to buy back the shares. Also, we know that the decrease, but in this case, in this specific case, it went up because the decrease in the number of years was much higher, or outweighed the decrease in the number of in the cash flow to equity holders. And usually, this is always the case when the cost of debt is lower than the return on equity, right? So whenever the company is able to issue debt at a lower interest rate than the cost of equity, it means that when they buy back the shares, they are able to buy back more shares than the decrease in cash flow for the equity holders. And because of this, the EPS goes up, right? And here something that is also important to note is that the increase in the EPS does not necessarily mean an increase in the share price as long as there is no interest tax bill, right? And as we have seen before, in this case, even though the EPS went up, the share price has not gone up because the cost of equity also went up. So the share price remained unchanged, right? So this is the part of this question. It's a bit shorter than the first one. If anyone has any questions, they can ask. Okay, cool. It seems there are no questions. Fredrika, do you think we can go through the second question?
Excuse me, what did you say?
Do you think we can go through the second question?
No, I think we will do that next time.
Okay. So that's all with regards to this specific question. It's a bit shorter than the first one, I guess.
Yes.
Yeah.
If you have any questions, you're free to stay in the Zoom meeting a little bit longer. Yes. Otherwise, we will see you later. Bye.